Hello, guys. My name is Joseph Ejike Oj, and tonight our focus of discussion will be on uh, foreign exchange market, and the other concepts that are involved in the trading of currencies. All right, let's begin. I want to make sure that you can see my screen. Yeah, I believe you can. All right, now foreign exchange markets. Sometimes we call it forex or currency exchange markets. These are mainly electronic markets where investors, speculators, banks, institutional investors, even private individual can buy and sell various currencies for profit, of course. They can sell this currency, they can buy and sell these currencies on behalf of businesses or for their clients or for themselves. As a matter of fact, you can be in your house and be involved in buying and selling currency. But I must tell you, it is the most volatile market in the world. Now, there's no physical building that is called a foreign exchange market. It's mainly uh, online or trading transactions that are connected to telephone terminals or internet. Now, the market determines the foreign exchange. So, how much current unit, how many units of one currency can be exchanged for the unit of another currency? This is the market where it is determined. So, and the foreign exchange markets involve or include all aspects of buying, selling, and exchanging currencies at current or determined prices. Again, it is the most volatile and most risky market in the world. It is also by far the largest financial market in the world and is comprised of mainly, like I said before, a global network of financial centers where investors, speculators, banks, private individuals, institutional traders can transact business 24 hours a day. It closes only on weekends. Really. Otherwise, it is open round the clock, unlike the stock markets that normally close at 4:30. This one is open round the clock, 5 days a week. Now, like I said, there is no physical market. I want to make sure I can see this. There's no physical market that is physical building that is called or named the foreign exchange market. It's a network of traders, who are connected via the internet or telephones. Nice. Now, this foreign exchange markets, like the stock market, we have a building like the New York Stock Exchange. We have the Chicago Mercantile Exchange. But the foreign exchange market is not like that. There is no formalized exchange. All currency transactions are done over the counter, called the OTC, which means that they are handled directly by dealers. Okay, so not only that, the foreign exchange markets are made of banks, I said earlier, banks, forex dealers, investment management firms, hedge funds, retail forex dealers, investors, and private individuals. All these people participate in the foreign exchange market over the counter. They are part of the network that is connected by either the internet or the telephone. Okay. At this point, we're gonna take a brief look at the commodity being traded at the foreign exchange market. What are the commodities that are being traded? Well, in the foreign exchange market, as the name implies, the commodity is money, currencies. And as of there are more than 118 currencies in the world circulating in 197 countries as of last year. So not all of them are actively traded, though. It depends on the country's, central bank policy. For example, the United States, as a matter of fact, more than 85% of all the currency transactions in the world involve US dollar. Okay, so that means that makes the US dollar the most commonly used currency in the world. How often a currency is traded is very, very important, because especially for investors and the speculators, because it shows how easy or how hard it is to get into the trade and get out of the trade. So that means the currency like the US dollar is actively traded. You can jump in, make quick profits, and jump out. But there are some currencies that are not actively traded. That means maybe you can get in fast, but to get out of the transaction might be difficult. So it depends on how demand for that currency is, and make you jump in and jump out. So normally I tell those that come to me to help them make money in the markets. Tell them I can't help you make money in the market. That's not my job. My job is to show you, teach you the principle of finance that involve in the foreign exchange market and in trades, how you can make money and how you can't make money. That is where our job ends. It is now up to you to follow the principle and the discipline that is involved. So I tell them, if you're investing or trading for alpha, I'm going to explain what alpha means in a minute. Then it is best for you to stick with the most actively traded currencies, which in this case are the US dollar, commonly called the greenback, the Japanese yen, the British pound, Swiss francs, Australian dollar, and Canadian dollar. These are the currencies that you can get in, far in, and get out, make money. Okay. In table, I'm going to show you a table now that explains some of the code, the currency name, the code, the symbol, and the share that each of these currencies have of the daily turnover in the currency market, according to the Bank for International Settlements. Now, before I do that, I want to explain alpha. Remember, I say that if you're investing for alpha, then it is best to stick to currencies that are actively traded in the currency markets. So, what is alpha? Alpha actually means, I call it a profit that you made above the market index. Remember, we have market indexes like, let me make this bigger, you can see it. Remember, we have the market indexes. So we'll write them down. Market index, like S&P 500 index. We have the Jones Industrial Average. Then we have NADEX. This so not NADEX, NASDAQ. Now these are the market. For example, the S&P is an index that tracks 500 largest corporations in US. The Jones mainly track industrial corporations, like those in manufacturing. And NASDAQ track mainly tech companies like Apple, Facebook, and Amazon. Those are what NASDAQ track them. So the three largest market index. Now, alpha is used in finance to describe whether a strategy or trading. I mean, when a trading strategy or portfolio manager has managed to beat the performance of these markets. If you're trading, if you are a manager that runs your fund can beat the performance of S&P in a given year, that means you have achieved alpha. So in other words, alpha is the active return on an investment, okay, and gauges the performance of an investment against a market index, a benchmark. And you can see some of those market indices. I think I can show you some of them online. The good news that we have Yahoo Finance that can show you all these indices. And see the S&P futures. And see those futures, NASDAQ futures, all this. So if your manager can beat any of this performance of this market, that means that manager has achieved alpha. So alpha simply means a measure of performance, indicating when a strategy or trader or portfolio manager has managed to beat the performance of any of these indexes. So now, if your manager cannot, if the fund manager cannot beat or cannot achieve alpha, what's the point in putting your money in their fund? If they can only make normal return. I mean, you can do that by yourself and make normal return. So why put your money in a fund that cannot achieve this alpha? Well, so they use it as a way to the yardstick for measuring how effective a fund manager is. So, and if you want to achieve alpha too, and on an individual level, that means you can want to beat the performance of these indices. That's when I recommend, if you want to do that, then you should trade on the most actively traded currencies, which are the US dollar, the euro, Japanese yen, British pounds, Swiss francs, Australian dollar, and the Canadian dollar. So let me now, having explained what alpha is, I can now show you the share of each of these currencies has of daily turnover in the currency market. You can see them from here. US dollar is highest. Daily share of trading volume, 84.9%. That's the largest. Followed by euro, 39.1%. Then Japanese yen, which is 19%, and the rest of the currencies here. At this point, we are ready to take a quick look at the basic concepts that are related to foreign exchange markets. Over the counter is one of them. Dealers is another one. Exchange rates, exchange rate quotation, base currency and counter currency, leverage, alpha. I've just explained alpha, so but we can go get a little bit more explanation on that. And investor and speculators. We're looking at some of this tonight, and in subsequent lecture we might finish the rest of them. Let's start with over the counter. Over the counter is a term that we use to describe the process of trading securities via a broker or broker-dealer relationship or broker-dealer network. So when you are doing over the counter means that you are buying, you are not going through the centralized exchange rate exchange like the New York Stock Exchange. When you buy and sell an asset, you are doing it via a broker dealer network, not through the exchange. So you are bypassing the exchange and going directly to the dealers or brokers to execute your trades. So the kind of the way it is these days, you can trade stocks, bond, derivatives via over-the-counter market. So and these are, I mean, it means that if you, the existence of this kind of market means that securities can be traded without being listed in the exchange. So also the securities that are traded over the counter are always or often facilitated by dealer or broker specializing in OTC markets. So the existence of this market, or help to promote equity and financial instruments that would be otherwise unavailable to investors. So without the OTC market, many people cannot get into trade, especially at the individual level. You have to get a special certification and license to be able to trade in the exchanges. But with over the OTC market, you don't need that. All you need to is your money and your skill. And then open an account with a trading platform, and they're in. So now, a broker-dealer is a financial entity that is engaged with trading securities on behalf of their clients, or it can be on behalf of themselves. I mean, they can trade for themselves too. Now, so a broker-dealer can even be a bank. It can be a bank, or just a trading platform that is linked to a bank. At the end of the day, they'll have to be linked to a bank. So, in other words, what the broker-dealer does is to act as a broker or an agent. So, let me put it in this way: a broker-dealer acts as a broker or agent when it executes orders on behalf of clients. But a dealer or a principal, a broker-dealer acts as a dealer or principal when it trades for its own account. So you say that it's a dealer or a principal. Now, which leads us to the next concept. It's called dealers. Now, a dealer is a firm or individual that buys from the exchange from one party and sells to the next party. So this means that corporations, investors, and speculators can access from the same market through dealers. So, and these dealers can be a bank, like I mentioned in my previous slide. Now, people that travel to other countries, maybe if you are traveling to another country and you want to exchange your currency for the local currency or for that other country's currency. Now, the airport kiosks where you can conduct or you can make the exchange. That airport kiosk can be your exchange dealer. Now, for corporations and mutual funds and even hedge fund managers, they might decide to call big banks that are involved in big banks that are also dealers. Usually, these big banks might have a separate section that they call investment banking section, where you can get the foreign exchange department. So big corporation can call on them, and they become their dealers. But for small individuals who are not involved in large scale foreign exchange transaction, it's just the airport kiosk will be enough for them. In addition to that, there are in some countries they have what they call bureau de change, where you can also get for a forex fund. So you can call bureau de change. I can call them a good example of they are also dealers. Okay. Now, individuals who are usually not trading large enough amounts of forex can do the trading through some foreign retail forex brokers. But I recommend that when you want to do that kind of transaction through a retail forex broker, make sure that it's one that is well regulated so that you don't lose your money. Even if there is something that is a problem, there will be a due process for resolving the problem because they are regulated. So, like I said, private individuals are not trading large enough amount of money to go to big banks like Goldman Sachs. So what they do is either you go through the change, or if you're trading for alpha, you can do that through retail forex brokers or exchange. In the United States, there are the 5 top US regulated forex brokers, which you can do. They are all online. They include the interactive brokers. This one, you can open an account. It doesn't require, there's no minimum to open an account there. Then you have your forex.com, where that require $1,000 minimum to open an account. I mean, as of today, the IG markets require $450 minimum. Then Think or Swim, which is owned by Ameritrade, requires $0. But if you want to activate that margin trading, where margin trading is where you can borrow money to trade, buy and sell currency. In that case, you have to have up to $2,000 in your account. Then Oanda, it doesn't require any minimum. So these are regulated retail forex brokers that you can use to buy and sell currency. Now we're ready to look at exchange rates. Now, a currency exchange rate, as the name implies, it means the value of one currency relative to another currency. I'm going to show you a table of forex that show different foreign exchange rates. Let me see if I got this for you. So I'm going to take you to this page and then bring it up. And see the exchange rate. See the US dollar is, so this means that the euro can buy 1.00382 US dollars. That means according to what you have on the screen here, so 0.99619 5 euros can buy 1.00382 US dollars. In a forex market, they go all the way to the 6 decimal places because the profit is really, really tiny. So to make more profit, it has to be a high volume trade. Now, it means that here, for this one, British pound, it takes one British pound, 1.15, I'll call it £1.15 cents to buy only 86, I'll call it 87 cents in US dollars. So you can see the different exchange you have. Even Japanese yen, say not up to 1 cent to buy 140 Japanese yen. So this is exchange rates that we have. I mean, this thing is current rates, and it varies, it changes every minute. Now, I want to show you something. When you look at this, I'm going to write this down. Write this down. Where's the paper? I want you to take a look at this. Well, these two things are related. You can see that when you do the inverse of this number, we have not up to one euro. So 0.9961, okay, 95 euros can buy as much as $1.00382. So if you look at this on Excel, you can see that if I put it here, equal 1 divided by, then I type in the number 996195. You see, I'm gonna get 0.10038, which is basically almost the same thing that we have on the screen there. Say 1103820. So this one is the inverse of this whole of these numbers, get all these numbers here. So this is how much British pound exchange to dollar and how much dollar exchange for British pound. It is also how euro exchange for dollar and how dollar exchange for euro. These are all shown on this for different currencies. And this for the current rate. Okay. All right. Okay. Yeah, having said that, we can go back to our presentation. So the exchange rate in case the value of one currency related to the other currency. So if you say that if euro versus this US dollar, euro/US dollar exchange rate is 1.002, it means that 1 euro can be exchanged for $1.002. This is approximately what we have on the screen over there. And if you say that US dollar, Japanese yen rate is 139.49, it means that 1 US dollar can be exchanged for 139.49 Japanese yen, which you can see from the screen. But the time I made this lecture note, the rate have changed actually. As a matter of fact, it means that right now you can see Japanese yen is 140.18. So that means 1 US dollar can buy 140.18 Japanese yen, not 139 anymore. By tomorrow it might change again, you know. Having said that, we can now look at other concepts here. Exchange rate quotation. So the way this money are quoted, you can see them in the screen here. How they are quoted. You can see I think in best here right here, you can see the quotation how they are quoted. You can see US Japanese yen. This place they show you only the percentage change. But this is how they quoted US euro versus US dollar. They just tell you they told you the percentage change here. But I'm gonna show you how they when they give you the actual currency. So I'm gonna go to financial. Oh, you know what? Investing.com will give us a better view. Investing.com. See if you can see the screen. Yeah, if you go to investing.com, and if you go down, you see where they are all quoted here. See the currency. You see US euro to US. That means I'll call it 0.9963 euro can buy 1 US dollar. See, if I want to use British pound, so that means 1 British pound is worth 1.155 US dollars. If I'm using US dollar Japanese yen, it's 1 US dollar can buy 140.15 Japanese yen. See? So they can see we call it this currency pair because they are put in pairs. Okay. All right. Now, so this quotation, I'll show you the pair how they are quoted. We have two types. We have the direct quotation and the indirect quotation. Under the direct quotation, the value of one currency, the value of 1 unit of a foreign currency is quoted in terms of the home currency. So normally we use the slash symbol to to show the currency pair. So the direct quotation method indicates the value of 1 unit of a foreign currency in terms of the home currency. So under the direct quotation, we have that the domestic currency. Let me put it this way. Yep, that's it. In direct quotation, the home currency is written after the slash. So you can see if we are using the US as the home currency, you can see that it is written after the slash. So this means that 1 euro can buy 1.00245 US dollars. So you mean that the US dollar equivalent of 1 euro is 1.00245. So under direct quotation, the domestic currency is written after the slash. But for indirect quotation, now we are using US we are seeing it from a US perspective. From the indirect quotation, the US, the home currency is written first. So, and the foreign currency, which is euro in this case, is written second. And that means that 1 US dollar, according to what you have here, 1 US dollar can buy only 0.9975 euros. So as you can see from here, the indirect quotation indicates the number of units of a foreign currency needed to purchase one unit of the home currency. So US dollar can buy this. That means you need 0.9975 cents to buy 1 US dollars. In fact, now you have seen the difference between these two methods of quotation. For the first one, we are seeing it from the US perspective, using US as the home currency. The direct quotation, the home currency is written second, I mean after the slash. So in our own case, the US dollar is the home currency, so it's written after the slash symbol. And for the indirect quotation, it is written before home currency, and the foreign currency is written second. But the relationship between the two can be expressed using this formula here. Indirect quote equals 1 divided by direct quote. Okay. Let us look at one more concept before we go into actually a few more concepts before we go into calculations. Okay. All right, let's see. All right, let's see. We're coming to that. All right. So now currency pair. I've already explained it. This is a good example. US dollar / euro. This. So you can see that the currencies are quoted in pairs. So a currency pair, exchange rates are understood as a base currency. You can call them base currency or counter currency. So this either this or that can be base or counter currency, but depend on the circumstances. So the base currency simply means the first currency quoted in a currency pair on a forex. So if we look at here, in this one, this is the base currency. On this one, this is the base currency. Okay, so the first currency quoted is often the base currency. In a currency pair, and usually the base currency is typically considered to be the domestic currency, or the accounting currency. So, example here, if you look at this, this is the base currency, this is the counter currency, and for this one, euro is the base currency, US dollar is the counter currency. So now, in a quotation that involves Japanese yen like this one, US dollars / GPS. In that case, US dollar is the base currency and Japanese yen is the counter currency. So this quotation here means that $1 can be exchanged for 108.77 Japanese yen. This is an old rate. It's much bigger than that now. Now we are ready to do some calculations at this point. Okay. So we're going to be using some calculators on this. Now, he said in 2013, the euro was worth 1.3075. Okay. And they say using the indirect quotation methods, determine the currency per US dollar. Okay. Now, let's put this on the calculator on the Excel and do the computation. It says take it there. So the direct quotation of the euro in that year, direct quotation is 1.3075. Okay. So I'm gonna put it in. Take it there. That's my Excel. So direct quotation is 1.3075. So the question is asking us to find it said on using the indirect quotation method, determine the currency per US dollar in for 2013. So you look at the formula here, one of our direct quotes. So having said that, we can just do 1 divided by the direct quote. 1 is already in here as 1 divided by direct quote. And that will give us the answer. This point, I can change it to dollars and increase. Usually 5 decimal places is enough, that. So that gives us the indirect quote. And if they give us direct quote, you can find the indirect quote. I want to show you here on this section. They say that I'm gonna make it something like that. So to get this one back, you can just do the opposite of this. You want to get the indirect quote, you do 1 minus. If you want to get back the direct quote, you can do 1 divided by the indirect quote. So if you have here equals 1 divided by the indirect quote, you get back your direct quote, which if you increase this, you can see that it's the same as we have here. Okay. All right. So you're enjoying this. Okay. Next is cross rate. Now, when it comes to cross rate, what you are trying to do is to find or conduct an indirect calculation of the exchange rate of one currency from the exchange rate of 2 other currencies. So to find the exchange rate of one currency from the exchange rate of 2 other currencies. So when we want to do cross rates, if the order of the currencies are the same, to find their cross rates, we simply divide the number at the first quotation, by the second quotation of that currency pair. Okay, so we divide the first quote with the second quote. If the order of the currencies are the same, like here, if you look at when I say the order of currencies are the same, you can see the order here. 140 Japanese yen and $1. 1.2 pound, £1 20 cents. I don't know exactly the smaller unit that they use in a British pound, but you can see the order here: dollar after the slash and dollar after the slash. So that's the same order. In that case, simply divide this to get the cross rate. But if the order of the currencies are different, in that case, what you have to do is to multiply the first currency quote with the second one. That will give you the cross rate. So let's see. Let's do an example. Now, if the dollars per pound is US dollar per pound is 1.614, 61224. You write it down. Dollar per pound, dollars per pound is 1.612, and then the yen per dollar, yen per dollar is you have 119. Okay. Now you can see that in this case, it says calculate the cross rate between Japanese yen and British pound. Okay, let's put these things in our Excel. Okay. We have dollar per pound. Dollar per pound is 1 point. Let me make sure I copy this right because you can make mistake. It's 1.6124. Okay. Okay, 1.6124. Okay, 1.6124. 1 minute. 6124. And next is the yen per dollar. Yen. Okay. Yen per dollar. Okay. Is 119. Okay. Now in that case, I think is more than that. I think I typed this wrong, but this one is 119.89. Sorry, 119.89. Okay, so I'm gonna correct this. 0.89. Okay, I'm taking you back there. 0.89. So the cross rates between cross rates. Okay, the cross rates. In this case, we are looking for the cross rates between. The question says, how do the cross rate between Japanese yen and British pound? Okay, Japanese yen per British pound. Take the symbol. So, hope Japanese yen. Okay, Japanese yen. Well, insert the symbol for Japanese yen. Hope we have it here. See, Japanese yen right here. Okay, per pound, British pound. Okay, so Japanese yen, the British pound now becomes. Now, we look at this too. We look at the equation that we have here. You see that the order is different. You have pound here after the slash, then after the slash, you have dollar. In that case, all you have to do is to multiply because the rule says if the order of the currencies is different, simply multiply the first currency, the second currency to get their cross rates. So what you're gonna do is multiply the two. Okay. So that cross rate becomes this times that. So that's going to give us the cross rate. And how do you write this? So you're gonna be this could be written as 193.31 Japanese yen per pound. Japanese yen, okay, per British pound. Japanese yen per British pound. See, that's the cross rate right there. I rounded this to 2 decimal. Let's make it up to how to have a 3106436 Japanese yen, British pound. That become our cross rate right there. See? So that's how you find the cross rate. And you can see the calculation as well in my PowerPoint. I rounded it to the 2 decimal places. Now, I like to use the real life, real life information to do our calculation. So we're gonna calculate the actual cross rate, the current cross rate between the British pound. Between Japanese yen and British pound. So to do that, look at dollar per pound, right? Okay, dollar per British pound. I'm going to take you to our table. We still have our table right here. Okay, so we have UF dollar. We have a pound per US dollar. So dollar per pound will be the inverse. This is the a direct quote for dollar. So dollar per pound will be the inverse of this. So it's going to be 1 divided by this number. Let me write this number down. This one means 1 British pound can buy $1, $1.1549. But how about dollar per pound? Like US dollar per British pound. So you have it, do the inverse of this. That's the inverse using the quotation, indirect quotation versus the direct quotation formula. So this is 1.1549. So we're going to put it in, okay, in Excel. So dollar per pound will be equals 1 divided by that 1.15. Okay. Oh, you know what? There's no need to divide it because it says here, according to what I have here, it said 1 British pound can buy $1.50, approximately $1.15. So 1.1549. Okay, I'm gonna write it down. 1.1549. 1.1549. And yen per dollar. Yen per dollar. And get it right here. How many yens per dollar? Okay. See, US Japanese yen. See, it's 140.15. 140.15 and 140.15. Okay. So that the cross rate will then become, I can just copy this formula here and it will calculate it for me. See, 1.61. So you have 161.859 235 Japanese put the symbol here, my symbol inside symbol. Japanese yen per British pound. Okay, Japanese yen per British pound. So that is the cross rate now, the current cross rate between Japanese yen and British pound. 161.85. So that's how you do it. So I did it with the numbers that were given previously in my slide. Then I did it with the current exchange rate for these two currencies. That's with the dollar, you know, and then I was able to calculate the cross rates for between the yen and the British pound. Okay, now let's do another example when the currency pair are the same. Look at this example here. It says if the yen per dollar is $140, yen per dollar, and the British pound per dollar is 1.2 per dollar. So this case, they have the same order of currency. So calculate the cross rate between Japanese yen and British pound. So they say the one we just did, they don't have the same, the order of the currencies are different. You have pound after the slash sign and dollar after the slash sign. But here, We have dollar after this, the forward slash sign, and dollar after this for forward slash sign. So the order of the currency is the same. In that case, just divide this with that. So let's put it in. Yen per dollar. Okay, take it to the Excel. I have, okay, I'll call it number 3. Okay, we have yen per dollar is, I got I'm gonna write this down so I don't have to go going back and forth. Yen per dollar is 140, and British pound per dollar is 1.2. So taking it back, all right, yen per dollar is 140, and pound, British pound, British pound per dollar is 1.2. Okay. In that case, the cross rates, okay, for Chinese yen and British pound, when the order of the currency is the same, in that case, you just divide the first quotation with the second quotation. Okay. So British yen per, okay, close this. Yen per pound. So then equals this divided by that. 166. See? So this is written as 116 points. I want to round this up to decimal places, which is 67. Okay. Japanese yen per dollar, per British pound. Okay. Japanese yen per British pound. Okay. That tells us the cross rate when the order of the currency are the same. Okay. So whenever you have to find a cross rate between two different currencies and they are given the quotes, the currency pair, you just follow this rule, a very simple rule. It says when the order of the currencies are the same, okay, divide the first quote with the second quote number with the second quote. When the order is different, multiply both quotes. Okay. So next, in our next lesson, we're looking at the leverage as it relates to foreign exchange transactions. Look at leverage. For now, I will stop here tonight. I hope you enjoyed the lecture. And if you did, don't forget to subscribe to my channel so that you will be informed or notified when there's a new lecture. Once again, my name is Joseph H. Gorgi, and thank you for listening. Good night.